Cass Johnson. He's the CEO of the National Council of Textile Organizations. The National Council of Textile Organizations represents the entire spectrum of the textile industry. Welcome.
Thank you. Good afternoon, Chairman Velasquez, Ranking Member Graves, and members of the committee. My name is Cass Johnson. I'm the president of the National Council of Textile Organizations. I think this is the third time I've had the opportunity to testify before your committee, and may I just say that you always tackle important subjects. We really appreciate it. You shine a light where many committees, for some reason, dare not go. I just want to thank you for that. The U.S. textile industry is the third largest exporter of textile products in the world. We export over $16 billion in goods to other nations. In that export context, I would like to touch briefly on a new topic, the availability of export financing for small businesses. As the last 12 months have shown, we truly live and compete in a global economy. Credit is an essential ingredient in that economy, and access to credit, particularly credit for export, has become a new and major competitive issue for our industry and for other sectors. During the financial crisis, Asian governments and banks reacted swiftly to ensure that export credit was not only available and plentiful. In April, China announced a textile revitalization plan that extended increased textile export subsidies and new credit lines and guarantees to its small and medium-sized textile companies. In August, Pakistan announced it was eliminating taxes on all textile exports and would be granting comprehensive insurance for all textile exporters. And yesterday, India announced that all textile exporters would now get a 2% rebate on their credit costs from the Indian government. Unfortunately, in regards to export credit availability here, the opposite has been the case. Our industry's access to export credit has been significantly reduced as U.S. government institutions, U.S. banks, regional banks, and private insurers have deemed the $25 billion textile and apparel trade between the United States and the NAFTA, CAFTA, Andean region to now be risky, and as a result have hiked fees, reduced credit, and withdrawn guarantees and insurance. To illustrate the problem, imports of finished apparel from Asia have dropped by 10% this year. That's about the drop in U.S. consumption. However, within the CAFTA, NAFTA, Andean region, imports are down by 22%. Accordingly, U.S. textile exporters have seen their exports decline by 24%. It will come as no surprise to hear, then, that our sector has been forced to lay off more than 50,000 workers since December of last year. When we surveyed our members as to why U.S. exports were in decline to the region, they universally responded that credit has been significantly curtailed to their customers in the region. We also learned that our mills are increasingly being asked to extend credit to apparel customers overseas who used to have their own credit, and that they're being asked to do so sometimes without normal private insurance or government guarantees that used to be in place. And while this has been occurring, U.S. mills have been squeezed by their own banks, who have instituted new fees, requirement, and standards for extending credit to them. To make matters worse, SM Bank has sharply reduced its activity for textile apparel trade in the Western Hemisphere, and according to our members and importers, guarantees almost no trade, none of that $25 billion trade in the region. As you can see, the entire credit chain for textile apparel complex in the Western Hemisphere is under strain. NCTO, the National Cotton Council, and our members have been examining programs in the SBA and the XM Bank in order to determine how best to restore credit availability. We have determined that with a few updates, the SBA's Export Working Capital Program could provide an essential assist during these difficult times. These modifications concern the size of the loans being guaranteed and the limit on the size of the companies that can access guarantees. These two components need to be updated so that textile companies and other manufacturing exporters can take advantage of the programs. Regarding the size of the companies, we are asking that the size limitations for companies in NAICS Code 31 through 33, which covers all manufacturers, be standardized at 1,250 employees. A number of NAICS numbers have limits as high as 1,500, but our companies, for instance, have limits at 500. This will automatically open new export opportunities for small and medium-sized enterprises in the United States and provide access to almost all textile exporters. Regarding the loan amount, we recommend a new export capital program be created outside of the 7A program. We suggest that the SBA set loan amounts at $5 million, $10 million, and $15 million that tie risk to the amount borrowed. The terms of the loan would be for 12 to 18 months and use standard SBA terms for interest rates. The guarantee level would be dependent on loan size. In closing, our industry has solid export opportunities in the CAFTA and NAFTA regions and has helped create a platform that today accounts for $25 billion in exports and employs over 1 million workers region-wide. However, faced by the reduction in export financing and well-capitalized competitors in Asia, we desperately need more financing and access to more financing options. We believe the SBA can play an important role, and we urge the committee to consider these two important modifications. Thank you very much.